Okay, welcome everybody. Today's session that I have the pleasure of hosting is on tax essentials. Now, while we've still got people trickling in, this is the lucky lunchtime slot. Some of you may not have been able to wait. Some of you may be already eating. So let's have a fun game. Can everyone put into the chat either what you're already eating or what you're going to go grab straight after this session? Make us jealous on this chat because we don't know what we want to eat. So we want some ideas. Thank you. Thank you, Aileen. I'm a sandwich person, to be fair. So some of these are sounding pretty good. Actually, good point to all our WA listeners and viewers. A little bit early, so feel free to put in what you're having for breakfast as well. Okay, and then also I'm seeing some people hopefully in later time zones who are going straight to happy hour after this. So also great idea. Nice. Tacos is always a good shout. All right. Look, we will get stuck in because we've got a good amount of people joining now. So I would love to introduce Stephanie Kalnilis and George Hartanto. Stephanie is a tax partner at RSM, and George Hartanto is a senior manager of tax services at RSM. And both of them are here today to guide you through employee remuneration. Myself, my name is Risha, and I'm a senior customer success manager here at Wheel. Sure, you've heard it already, but Wheel is Australia's leading spend management solution, and we're here to empower finance teams of all shapes and sizes. Now, while Wheel is the team behind the CFO Summit, we could not have done it without our excellent partners, that being CFO Magazine, Fathom, and Translucent. So thank you to all of them. Bit of housekeeping before we get stuck in. Look, tax is not the most glamorous subject. It definitely needs a bit of a better marketing campaign. So we want this session to be interactive and fun as much as possible. So I really encourage you guys to get creative with the questions that you ask our experts today. Really think outside the box. I want to really put them to the test. When asking questions, please use the Q&A function, not the chat function. That way we can just keep it all in one place and make sure none of your great questions get missed. Look, that's really it in terms of housekeeping. I will pass it over to Stephanie and Greg.
Perfect. Thank you. Thanks for that introduction, Risha. As Risha mentioned today, we're probably going to cover off a fair bit in terms of employment tax essentials. So some of the topics that we'll cover off are the employee share scheme provisions. So first, in a general sense, to make sure that we've got an even starting position, and then we'll talk in a bit more detail about tax structuring and some advantages and disadvantages of using employee share schemes. Following that, we'll run through briefly on the new payday superannuation provisions. These will be pervasive. They will apply from the 1st of July 2026. And there is, in some instances, a real need to start thinking of ways to make sure that you're compliant as an employer. And then, if time permits, we'll run through the recent FBT updates, most significant being the sunsetting of electrical vehicle exemptions for plug-in hybrids. So as Risha mentioned, we like to do things as well casually and informally. We'll walk through a lot of technical detail, but please feel free to throw in any questions that you have, and we can keep it conversational if that's the way it flows. So I'll just start by giving a very brief introduction to what an employee share scheme interest actually is. So the hallmarks of an employee share scheme interest is that it is a beneficial interest in either a share or a right to acquire a share. So for example, an option in an employer company or one of its subsidiaries that is issued to the employee of the employer at a discount to market value, and it is issued in respect of the employee's employment relationship. These are the three characteristics that are needed for an interest to be characterized as an employee share scheme interest. Notably is the discount, because this impacts the way you might structure the issuance of a share or right. If you issue a share or right to an employee, but they have to pay market value consideration, there is no discount. And so that interest is not taxed under the ESS regime. It's directly treated under the capital gains tax provisions where you've got an employee paying to acquire the interest. Income from an employee share scheme interest is actually accessible to the employee. It's assessed to them at their marginal tax rate, and it is included in their income tax return. as an employer, there's not necessarily a PAYG withholding obligation. There can be in very limited circumstances, but employers prima facie only have a reporting obligation to the employee and ATO. So why would an employer implement an employee share scheme as part of its remuneration? Employee share schemes are actually gaining significant traction, not only in Australia, but globally. They're a real good strategic alignment tool. They align the interests of the employee with that of the company. So one of the fundamental advantages, I guess, is the ability to boost employee motivation and retention. When employees have skin in the game, when they're looking at things from the lens of a shareholder, they have a vested interest in the company's success. So as shareholders are more in tune, they're more in tune to the financial success and the strategic objectives of the company, and that serves to drive increased collaboration and continued improvement in growth. Another fundamental advantage is the ability to attract or retain top talent. And particularly if you're looking at it from the lens of a small startup that is cash constrained, that might be a significant differentiator to potential candidates in that it indicates the willingness of the company to allow employees to benefit from the growth that they help generate. So really that potentially opens up higher caliber candidates that aren't necessarily just in it for a salary. They might have an idea, they want to go on a growth journey, and they want to be incentivized to have a platform for meaningful growth and contribution. And then another advantage is the tax advantages that can be built in or structured into an employee share scheme plan. I won't go into too much detail on that because Greg will cover that in a bit more detail throughout the latter half of this presentation. But suffice it to say, you can end up in a situation where you either have an exempt ESS income amount and you have this interest in a company, or you could end up having a scenario where you get concessionally taxed under the capital gains tax regime as opposed to the employee share scheme at your marginal rate. Some of the things to consider when you're looking at implementing an employee share scheme is the administrative complexity. So there will be regulations to consider from an ASIC compliance perspective, as well as other tax provisions that need to be navigated. The cost of setting up an employee share scheme, that might involve advisor costs for initial setup, ongoing reporting, and then potentially in terms of the valuation of employee share scheme interests in communication with employees, and then again as well around handling the logistics of employee share issues and transfers. Another potential drawback or thing to consider, and this is perhaps more relevant for privately held companies, where the founders of the company might hold a significant interest and have a concern around the dilution of ownership, or the dilution of control, particularly in an environment where that concentrated ownership is crucial for strategic decision making. So these are just sort of some of the things to bear in mind when considering whether to implement an employee share scheme plan. And now just touching on what again should be considered from a structuring perspective, more in a general sense than a tax specific sense, but one of the important things will be to clearly understand and define what are the objectives of the scheme itself. Is it to incentivize performance, to retain talent, to encourage long-term investment, or is it to simply reward employees for their contribution? So knowing what the strategic objective of the plan is will drive the direction of how the plan is structured and any vesting conditions that you build into the plan. Choose the right type of scheme. You can have an option plan, a share plan, phantom rights, share purchase plans, performance rights, etc. There's lots of different variations. The right plan will depend on what you're trying to achieve and what the profile is of your participating employees effectively. Where possible, the scheme should be designed as simply and as clearly as possible. Vesting conditions should be clearly communicated to employees, so they should know what their rights are, what conditions and restrictions apply in respect of their interests, what benefits they'll receive, etc. And then in terms of the vesting conditions, these should be set to be aligned with the company's strategic objective. If the objective is to encourage retention, then it might be, for example, a vesting based on time conditions. If it's to reward or incentivize high performers, then the vesting conditions might be placed on an individual performance metric, or if it's to designed to incentivize shared economic performance, then the vesting conditions might be tied to some sort of group performance metric. So just in terms of how the ESS provisions operate or interlock with other taxing provisions, I mentioned before that the ESS income is taxed to the employee in their own return at their marginal rate. The ESS income in that sense is essentially just the discount. So it will look at the difference between the market value of the employee share scheme interest at the relevant taxing point, and it will compare it with the amount that the employee had to pay to acquire that interest. So the ESS provisions have first bite of the cherry. They always apply prior to the capital gains tax provisions. And the capital gains tax provisions are effectively not enlivened until the employee share scheme provisions have first applied. An employee share scheme interest is expressly carved out of the Fringe Benefits Tax Act. So if a sharer right is taxed as an ESS interest, it can't then be taxed as an intangible property benefit under the Fringe Benefits Tax regime. So I've got here just a very quick and brief example illustrating the interaction between the ESS rules and the capital gains tax provisions. In this scenario, we're looking at an option. It's taxed on a deferred basis, which Greg will explain in a bit more detail as well. But at day one, the market value of the option itself is $1. The amount the employee pays is nil. So there's implicitly a ESS discount. However, because this option is being taxed on a deferral basis, that isn't necessarily a relevant factor. When the employee exercises the option, they are thereafter free to sell their shares. So at this point in time, we've got the crystallization of a deferred taxing point, and we're now considering the market value of the option itself at the time of this deferred taxing event. So in this case, we had the option that we have an underlying share with a market value of $5, and the exercise price to acquire that share is $1. So therefore, the market value of our option is $4. The employee paid nothing to actually buy that option in the first instance. So their discount is $4. That is what they're taxed on in that deferred taxing year event when they lodge their income tax return. Now, fast forward down the track, the employee has subsequently gone out and sold that share. And at that point in time, the way the CGT provisions operate is that the employee is deemed to have acquired the underlying share based on the market value of that share, which is $5. The sales proceeds that the employee receives on sale of that share is $10, leaving them with a gain of $5. Now, as Greg will touch on down the track, because that is taxed on capital account, that might potentially be accessible to a capital gains tax discount. So that's just sort of a very quick and high level example that we can comment on in further detail. And then just a brief comment about ESS reporting. If you're not familiar with those provisions, there's essentially a reporting obligation to both the employee and the tax office. The ESS reporting is triggered by taxing events, so it is really important for an employer to understand the different types of equity plans it has on offer and what the potential taxing events are, whether it's on grant, if it's on vesting, exercise, sale of their underlying share. That's something that's really relevant to know. Once you've defined the actual taxing events, then you can collect the relevant data with reference to that taxing event and affected employees. And that will facilitate the generation of the employee share scheme statement and annual report. In respect of employee reporting, that is due 14th of July, following the end of a year in which you've got a taxing event. And that information essentially informs what the employee will use to prepare their income tax return. It is also what the tax office uses in a data matching scenario. Additionally, we have the annual report that must be supplied electronically to the tax office by the 14th of August following the end of the income year. That can be done by the business portal. It needs to be done electronically. If you, however, have more than 50 employees to report on, then that needs to be done via an external vendor or a share plan administrator. And then finally, just noting out for completeness, payroll tax is something that should also be considered. ESS income does form part of taxable wages. However, unlike income tax reporting, the ability or the timing of when you report for payroll tax purposes is at the employer's discretion. So that can either be done upfront on grant or on the occurrence of a vesting event. So really the way you prepare your return at the time of grant will be indicative of whether you've elected to tax at that point in time relative to the vesting point. So I think that sort of rounds out the general reporting requirements and things to consider. I'll now hand you over to Greg, who will look at the tax considerations in a bit more detail.
Thanks very much for that, Stephanie. So I'll first start off with covering the ATO's three main policy goals with its ESS taxing regime. So the first is that employees receiving ESS interests at a discount to market value should be assessed to tax on the discount at their marginal tax rates. The second is that in most circumstances, the timing of this tax should be deferred if the employee is at a real risk of losing the ESS interest or is restricted from disposing of it. The third is that tax concessions should be provided for certain schemes carried out by startup companies to encourage the use of ESS as an effective remuneration tool to attract and retain staff. So I have here a table which covers the three main regimes when it comes to taxing ESS. The first is upfront taxation. So this is where employees are taxed on the market value discount they receive when they are granted the shares or options in the company. So the tax for the employee in this scenario would arise upfront at the grant date. This is the default taxing regime, so an ESS plan will fall into this category unless it is structured in a way where it's eligible for one of the other taxing regimes. In terms of pros and cons, the main downside is that the employee is taxed upfront, which means that they could be taxed before they're actually able to realize any financial benefits of owning the ESS. Now, this may not be too bad for early stage companies where the market value of the share currently is low and may not give rise to much tax for the employee. There are also some benefits to upfront taxation. The first is that there is an ATO concession for upfront tax schemes where the first $1,000 of the discount may be tax-free for employees that earn less than $180,000 and where certain criteria are met. So this could potentially reduce the taxable discount to nil. There are also some benefits in triggering the ESS taxing point early, since, as Stephanie mentioned before in her example, that ESS discount income that the employee is taxed on first will not qualify for any 50% CGT discount for the employee. However, after the ESS taxing point, any further gain in the shares will be taxed under the capital gains rules, and any growth from then on may get a 50% discount when it's finally taxed to the employee. So the next regime is the deferred taxation regime. This is where employees are taxed at the time where their interests have vested and they're eligible to dispose of them. There are a few conditions which have to be met for an ESS plan to qualify for deferred taxation. For example, the ESS must be over ordinary shares only. The employee must not hold 10% or more in the company immediately after the ESS interest is issued, and the shares and options must be at a real risk of forfeiture to the employee or have disposal restrictions attached at the time it's granted. The benefit of the deferred tax regime is that the employee will not be taxed on the discount until the ESS interest vests and they're able to dispose of it. It's only at that point where they'll be taxed under the ESS rules. However, the downside is that any growth in the value of the share from grant date up until this taxing point won't actually qualify for any 50% CGT discount. The final taxing regime is the concessional ESS startup taxation. So under this regime, employees are not taxed under the ESS rules at all. Instead, when they're granted their options or shares, it skips straight to CGT taxation and the employee won't be taxed until they actually dispose of their ESS interest. Now, this is good because the employees kind of get a best of both worlds in that they're not taxed initially on the grant of the share. They won't get taxed until they actually dispose of their ESS interest. And also the full amount of growth from that grant date until they actually dispose of it will likely be eligible for a 50% CGT discount. The main downside is that one of the conditions to get into the startup concession is that the employer cannot provide a significant discount when issuing the ESS interest initially. This means that if an option is being issued, then the exercise price of the option must be at least the market value of the share at the grant date of the option. If a share is being issued, the employee must actually pay for the share. They must pay at least 85% of the market value of the share at that time to acquire it from the employer. So this next slide just lists the sort of full ESS startup concession conditions. I'll just rattle through them briefly. So the shares can't be in a listed company. The company and all associated companies must have been incorporated for less than 10 years. The company, together with any of its connected companies, must have a turnover of less than $50 million. The company must be an Australian tax resident. Its predominant business must not be in share trading. There must be a minimum holding period in the ESS plan rules. This means that the participants can't dispose of their options or shares earlier than either 3 years from the grant date or when the employee ceases being employed by the employer. The shares must be over ordinary shares, and right after the grant of the ESS interest, they cannot hold more than 10% of the shares in the company. The last two conditions there are about the not significant discount that I covered earlier. So this slide lists a few common ESS structures along with when an employer might seek to use them. The first is an option scheme. So this is good for companies who want flexibility in determining their vesting conditions, the exercise price, and vesting periods for their plan. The second is a restricted stock unit plan. So this is where employees are granted rights that will vest into ordinary shares after certain vesting conditions are met. So this has the same upside as an option scheme, but may become better for companies in a mature stage where the market value of the shares is substantial and the exercise price may be a deterrent to employees. The third is a loan-funded share plan. So this is where the employees are granted shares in the company at market value, but funded by a loan from the employer. So this has the benefit of skirting around the ESS taxing regime because, just as Stephanie said, since the employee isn't getting a discount, then it skips straight to the CGT rules and isn't taxed under the ESS rules. What this means is that the employee won't be taxed until they dispose of the share in the future. And it also means that they will likely get a CGT discount for any growth up until that point, as long as they've held the share for more than 12 months before disposal. So generally, a loan-funded share plan may be useful for executive or founder plans where you have participants who will hold more than 10% in the company. And those people would usually be taxed upfront on the grant of any options or shares because they can't access the deferred taxation or the startup concession regime. However, if you are planning on using something like this, then employers must be wary of pitfalls. For example, if the plan or the loan isn't structured appropriately, the loan could actually be a deemed dividend to the employee, or the employer may be liable for FBT on the loan, which it will want to avoid if possible. So now that we've covered some of the tax concepts, I'd like to cover some key tax considerations and strategies when designing an ESS plan. The first is that it's important to consider what will be the timing of the employee taxing event. As discussed in the summary before, there is a bit of a balancing act between deferral of taxation versus getting the most out of the CGT discount. Now, if the company is eligible for the startup concession scheme, this is all good because, well, it gets the best of both worlds. But if the startup concession isn't available, then the employer should think about whether upfront taxation or deferred taxation would be most tax efficient for its employees. As an example, early stage company, low share price, but expecting a large growth in the future, an upfront tax plan may be best, as any upfront tax to the employee would be low or even nil with the $1,000 reduction, but they would benefit greatly from having a CGT discount for any share growth after the ESS taxing point. On the other hand, if you're a mature stage company, your company share value is quite high, then deferred taxation may be beneficial for employees, since otherwise they would have to pay a significant amount of tax upfront before they're actually able to sell their option or shares. Another thing to keep in mind for ESS plans which fall under deferred taxation is that the tax time for the employee won't necessarily be on the vesting date or even the exercise date of the plan. The taxing point only happens when both the ESS interests vest and the employee is no longer restricted from selling the shares. What this means is that if there's something in the plan rules or the shareholders agreement which restricts the employee from selling the shares even after they obtain them, then the taxing point may be pushed further back until such restrictions are lifted. So this can be a useful tool for employers designing the ESS plans. Lastly, a key point to remember is that unless you meet the eligibility conditions for the ESS startup concession, employees which held and exercised options or restricted stock units must hold the actual shares themselves post-exercise for over 12 months in order for them to be eligible to get a CGT discount. What this means is that options or RSU plans which have exit-only vesting conditions, so this means that the employee can't get the share or they can't sell the share unless there's a company takeover or a listing, these kind of plans are unlikely to allow employees to get any CGT discount. Based on the goals of your specific ESS plan, this may still be the best way to design the plan, but the tax considerations should be something that is kept in mind. So the last thing I want to cover is a few considerations for employers with an ESS plan in place. So the first is to ensure that you know which taxing regime applies to your ESS plan and that all eligibility conditions apply. This is especially important because the employer has the obligation to undertake the ESS reporting and let the employee know when they are taxed under the ESS rules. Lastly is to be wary of pitfalls with loan-funded share plans. So if a loan is being issued to an employee who is already a shareholder prior to being issued the ESS interest, this may result in the loan being treated as a deemed dividend from the company to the employee. And secondly, if the loan you give to an employee is interest-free, this may potentially subject the company to FBT. One exception to this rule is that if the company's shares are ones that regularly pay dividends, then generally this would mean that FBT can be avoided on that loan. That covers it for the rundown of the tax basics of employee share schemes. I'll now pass it back to Stephanie, who will talk about some upcoming superannuation reforms.
Thank you for that, Greg. I'll just make a quick comment. I've seen some really great questions come through the Q&A. So we might cut it off after super so that we've got ample time to cover that off. But just a bit about the superannuation changes which are slated to come into effect from 1 July 2026. So these are not yet law, but exposure draft legislation was released last Friday and the consultation period on that legislation closes on the 11th of April. Under the new payday provisions, employers will be required to pay employees their superannuation guarantee at the same time as the salaries and wages. Previously, this was at the end of a quarter. The superannuation guarantee must be received by the employee super fund within 7 days of the payday event. Otherwise, the superannuation guarantee charge is payable. Now, anyone who's had experience with the superannuation guarantee charge knows how particularly punitive it is. The SGC is recalibrated under the new superannuation amendments, and that is really to reflect from a policy perspective the seriousness of late payment and underpayment of super. As a result of the superannuation changes or in conjunction with those changes, Single touch payroll reporting will also change. Employers will now be required to report ordinary times earnings and superannuation guarantee liability for employees, whereas previously OTE was optional in lieu of reporting salaries and wages. And a choice loading will apply if an employer fails to comply with its choice of fund obligations, which is essentially the obligation to provide a default super fund and give an alternative option to the employee at their discretion in terms of their superannuation fund. And that will come in the form of a loading rather than an increase to the superannuation guarantee shortfall as the base for calculating a penalty. The payday reforms will focus more so on it's in response to the growing claims for wage theft and unpaid super, and it's part of a broader initiative to focus on employer payroll and wage compliance. The intention is that it will give employees greater visibility over their growing superannuation balances, and in theory, any non-compliance should be identified in real-time basis so that it's corrected quite quickly. I'll just now touch on the changes to the superannuation guarantee charge. In the current form, the superannuation guarantee charge, if payable, is not deductible for income tax purposes. Any superannuation guarantee shortfalls based on salaries and wages, not that subset that relates to ordinary times earnings. The notional interest applies at a 10% nominal rate per quarter, accruing from the start of the quarter, sorry. The administration fee is $20 per employee per quarter. Under the proposed reforms, the superannuation guarantee charge will still comprise of 3 components. It is proposed to make this a tax-deductible penalty. However, the superannuation guarantee shortfall will be calculated based on ordinary times earnings, not salaries and wages. Notional earnings will be calculated with reference to a compounding daily interest rate, which is reflective of the general interest charge rate, and that will accrue from the first day that the underpayment or late payment occurs. There will also be an administrative uplift, which will be calculated at a starting point of 60% of the superannuation guarantee shortfall. In its previous form or in existing forms, there is limited discretion to reduce the application of calculated superannuation penalties. However, under the proposed provisions, this will be a prima facie rate, and there is the ability to have that rate reduced on account of good compliance history over the last 2 years, and also on prompt voluntary disclosure to the tax office within 30 days of a non-compliance event. So if a breach is detected internally, employers are encouraged to report that quite promptly to the tax office. In addition, if a super guarantee charge is assessed but remains unpaid, general interest charge will accrue on that. If it's not paid within 28 days, then a further superannuation guarantee charge penalty of up to 50% will apply. So it's really important to ensure that everything is done on a timely basis, including reporting of non-compliance, because the penalties just continue to increase in that event. And importantly, whilst the superannuation guarantee charge, being 3 components, is proposed to be deductible, any general interest charge on late payment of the superannuation guarantee charge itself and related penalties will not be deductible. The 2 exceptions for the 7-day requirement will be a 2-week grace period for a new employee that starts in a business. And again, just noting that any small or irregular payment that occurs outside of the typical pay cycle won't be considered a payday event until the next regular pay cycle occurs. Cool. So from an employer perspective, some things that you might want to consider in terms of preparation, payroll timing. So processing time is now more critical than ever. So employers should assess whether the changes, including primarily the increased frequency, will impact on payroll's ability to process the superannuation contribution on time. As part of this, employers should consider if there are any automations that can be built into the process to expedite processing of super, and review the suitability of the current pay cycles. So if you're currently on a weekly, fortnightly, or monthly cycle, and how that is whether that is adequate for future needs and how that interacts with cash flow planning, noting that the superannuation guarantee must be paid immediately after the pay run, as opposed to in the quarter following. Superannuation compliance testing, just noting that with the introduction of single touch payroll phase 2, the ATO can now in real time collect information to determine if employers are paying superannuation appropriately on ordinary times earning wage codes. As a first step, we'd recommend that employers conduct a wage code review to ensure that the super guarantee is calculated on all applicable payments and that the STP reporting codes importantly are aligned with those OTE flags. And then review your onboarding processes and controls regarding the onboarding of new employees, and just ensure that these are fit for purpose in terms of updated reporting requirements for when a new employee joins a business. So I think I'll probably close off there. Risha, would you like us, should we close off now for Q&A?
I think that's a good place to stop. What I will say is if anyone is interested, we will put them in touch with you to discuss any of these points further. But there are some good questions coming through. The one that I'm particularly interested in is if someone hasn't set up a ESS at their company yet, and this is kind of their first foray into it, a lot of great information, but it can be a little bit daunting.
Absolutely.
What is like your advice? What is step one? What's the easiest way to kind of enter into this and get the conversations going?
Yeah, absolutely. So look, it can be daunting. The one thing I'll say about the ESS provisions is they're very clear in terms of whether you're deferred, upfront, or small startup. Where I would start is, do we qualify for the small startup? Because that will provide you the greatest benefits for your employees, even as an employer. And there is lots of ATO commentary and guidance and pro forma templates to make you compliant from a regulatory perspective. So first port of call would be to check if you meet those conditions for small startup concessions. If not, then it's understanding the overlay between whether you're upfront or deferred, and there's specific conditions for those. So like the default position is that if you issue an ESS interest, that you will be accessible on grant, unless you meet the conditions for deferral, in which case you must apply deferral. So there's a very clear pattern there. And it will really depend on what you want. So the beauty of this is, depending on what you want as your basis to the strategic objective of the plan, it can really be built around that. But I would always say start off with the small startup concessions. If you're a company that's been in existence for less than 10 years, you're not listed, and if your turnover is less than 50 million on an aggregated basis, that is definitely the place that I would be starting with.
Absolutely agree with what everything Steph said there as well. And the only other thing I'd add is that for employees, a lot of the time this is going to be very confusing. So a lot of the times what we see employers do is they definitely have some sort of cheat sheet, just a little like 2-3 page document with some FAQs, making sure that employees know what the actual tax implications is to them, making sure they know what's in it for them, the potential upside, and that you'll get to grow your shares and realize the financial benefit in the company. So really it's all about communication so that no one is surprised if they have to pay tax at a certain point in their ESS.
That's actually a really good prompt onto the next question, which is, yes, about employee education, but also buy-in from senior leadership. Whether you're a finance person or not finance person, most of your senior leadership are the ones who are going to get the questions from their employees. So do you recommend kind of specific training programs for them? Is it very niche to the business? Yeah, do you have any advice on this front?
Yep.
Certainly,
yeah, I can take that. So yeah, certainly it's something that I think the senior leadership should be very in tune with actually designing the programs. So definitely we recommend any senior leaders to have a good grasp of just the basics of the ESS. Obviously, having these conversations with your tax advisors, they should be able to fill in the gaps wherever they may be. And making sure that you know 100% how the plan will operate so that there's no surprises when it comes to future tax reporting.
Appreciate there's a couple of interesting questions. I think there's one here from a Lauren,
Yes.
which is looking at the options, looking at alternatives between options, RSUs, and loan funded plans. In that particular instance, from an employee's perspective, probably the loan funded plan. But the other side of the coin there is that with the loan funded plan, because the employer is essentially lending you the amount so that you can buy the share or right at market value, you're not under the ESS rules. So effectively, from day one, you are in the capital gains tax regime, which, obviously provides access to a CGT discount if you're an Australian resident and you've held the interest for more than 12 months. The other side of the coin there is, though, you've got to, and Greg's alluded to this, is you've got to properly manage it from a fringe benefits tax perspective, because the incidence of FBT falls on the employer. So the employer will pay fringe benefits tax where it's applicable. And here, where you might see the incidence of the fringe benefits tax is you've provided a loan to the employee, essentially. So if that is not an interest-bearing loan, then there's a possibility that the notional interest on that will be taxable as a fringe benefit. You can probably structure it to get around that, because there's a concept of, if that interest would have been otherwise deductible to the employee, then potentially the taxable value of that from a fringe benefits tax perspective is nil, really. It's more an interplay between them, but certainly if you're looking at it from an employee's perspective, the loan funded plan gives them the best benefit, and that also takes ESS reporting off the table. And I see a question from Matthew regarding the superannuation guarantee charge if an employee's incorrectly submitted their onboarding documents. Are you aware of any changes in the legislation that prevents the employers being liable for the employee's mistake? No, actually, I'm not. I haven't come across anything in the legislation to specifically on this point, although I have to admit it could be something I've missed in the exposure draft, but certainly, as I'm aware, or I know the CIS regulations have also been amended around the choice loading, but I haven't seen anything that sort of mitigates the employer's obligations in that particular respect. So I'm happy to take that, though, on advisement and come back to you if there's any different opinion.
Look, that kind of leads us on to a good prompt. We're going to just release a poll into the chat for everyone. If you would like to hear more from Stephanie and Greg, please just say so, and they can reach out, or we can send you for more information, including a recording from today's session. So if you can, let us know if you're keen to hear more from the RSM team.
Risha, I'm going to tick a yes for myself.
Perfect. I'll do the same. Cool. We'll give that a few more seconds for everyone to answer. And again, appreciate all the questions. Please feel free to keep asking them after the session. Like I said, recordings will be sent through as well as the slides. So you'll be able to review all of this afterwards.
And could we just take a moment to say thank you so much for your time. We really have enjoyed presenting, and we hope that you took something out of the session.
Yeah, thank you everyone for joining. And time for lunch, as mentioned. So please go have your coffees, your tacos, your sandwiches, have your soups. And we will see you back at 1:30 Sydney time for app speed dating with Translucent, Trace, and Wheel. So thank you, everyone.
Thanks, Rachel.
All right, bye.
Thanks,